You're sitting at the kitchen table after a long day, phone in hand, bills on the counter, maybe a retirement calculator open on your laptop, quietly judging you, and then it hits you. One of those posts, one of those headlines, one of those everyone's talking about it stocks. The comments are loud. The chart looks like a rocket. The story is irresistible. AI, innovation, the future, the next big thing. Your thumb hovers over the buy button, right there. Before you do anything, ask 3 questions, not 10, not 50, 3. Because if you can't answer these 3, you're not investing. You're taking a chance with your future. Here they are. Could this company survive a bad decade? What is it worth in a calm world? Not today's market mood? And at this price, am I getting paid to be wrong? If you stay with me, you'll be able to look at almost any stock and in minutes know whether it deserves a deeper look or whether it's a trap wearing a great story. And I'm going to warn you, the most dangerous mistakes don't feel dangerous. They feel exciting, they feel smart, they feel like you're finally early. Benjamin Graham spent his life trying to protect ordinary investors from that feeling because the market is not designed to make you wealthy quickly. It's designed to separate you from your discipline. Let's start with the problem nobody wants to admit. Most people don't lose money because they're dumb. They lose money because they're rushed. They buy because everyone's buying. They sell because everyone's panicking. They confuse activity with progress. They confuse volatility with risk. They confuse a rising price with a rising value. Graham's entire philosophy, security analysis, the intelligent investor, was built on one brutal truth. Price is what you pay. Value is what you get. And the gap between those two things is where fortunes are made and where retirements get wrecked. So think of these 3 questions like an emergency room triage for stocks. Not a full diagnosis, not a perfect valuation model, not a promise of easy money, a fast way to separate maybe from no, a way to stop wasting time on story stocks, hype cycles, and financial statements that only look good because someone adjusted reality, a way to calm down Mr. Market because Mr. Market, the character Graham invented, is not your mentor. He's your neighbor who bangs on your door every day, offering to buy your house or sell. You his with a mood swing and a hangover. Some days he's euphoric and names a ridiculous price. Other days he's depressed and begs you to take it off his hands. Your job is not to match his mood. Your job is to stay businesslike. Now, question 1. Could this company survive a bad decade? Not a bad quarter, not a rough earnings season, a bad decade. This is where most modern investors tune out because it's not fun. It's not exciting. It doesn't trend on social media. But it's the foundation of defensive investing. Graham didn't start with the dream. He started with the balance sheet because the balance sheet tells you what happens if the dream hits a wall. Here's the easiest way to feel this in your bones. A company can have an amazing product and still be a terrible investment if it can't survive when money gets tight. And in a world of shifting interest rates, inflation shocks, recessions, credit cycles, money does get tight. So what are you looking for? You're looking for staying power. You're looking for financial strength. You're looking for a business that doesn't need perfect conditions to keep breathing. Start with debt, because debt is what turns a normal downturn into a permanent loss. If a company has heavy debt, it doesn't just have to be right eventually. It has to be right on time. And the market doesn't care about your timeline. Ask, is debt rising faster than the business is improving? Ask, Is the company paying interest comfortably or barely? Even without doing fancy math, you can sense the difference between manageable and fragile. A fragile company may look brilliant in a boom, but when conditions change, it starts issuing more shares, selling assets, cutting corners, begging banks, and diluting you quietly. And dilution is one of the most underappreciated traps for the everyday investor. If the share count is creeping up year after year, you might be buying a slice of a pie that keeps getting cut into more pieces. Your portfolio statement won't shout this at you. The chart won't warn you, but the ownership you think you have is quietly shrinking. Next, cash. Cash isn't just nice, it's time. Cash buys a company options. It buys flexibility. It buys survival. When you see a company with a real cash cushion, especially compared to its obligations, you're seeing a business that can endure a storm without begging the market for mercy. And that matters because in a crash, the market doesn't give mercy. It demands discounts. Now look at earnings history. Graham loved stability for the defensive investor, not because stable earnings are glamorous, but because they reduce the odds that you're fooling yourself. A company that's profitable through different environments is telling you something. A company that only looks good in perfect conditions is also telling you something. This is where many hot sectors fail the test. In the middle of a boom, earnings can look great. Revenue can explode. Growth rates can look like destiny. But then you realize the company's profitability depends on cheap capital, aggressive adjustments, or customers who only spend freely when the economy is wide open. And suddenly, your investment is really a bet on the mood of the world. If you take only one practical habit from question 1, let it be this. Before you read the story, read the balance sheet. Before you watch the CEO interview, look at debt, cash, and dilution. Before you fall in love with the future, check whether the company can survive the present. Because if a company can't survive a bad decade, you don't own an asset. You own a situation. And here's the twist most people miss. Even if a company passes question 1, financial strength, real staying power, you can still lose money badly. Because the second question is where great company and great investment split apart. Question 2, what is it worth in a calm world? Not today's market mood. This is the heart of price versus value. And I want you to notice something. The question is not, what will the stock do next week? It's not, what will Wall Street think after earnings? It's not, is AI the future? Or will rates fall? Or what's the next catalyst? It's, what is the business worth if everyone calms down? Because intrinsic value is not a vibe. It's not a meme. It's not a trend. It's a conservative estimate of what the business can produce for its owners over time. Graham never pretended intrinsic value was a single perfect number. He treated it like a range, an estimate grounded in reality, not prophecy. So, how do you move fast without turning your brain off? You normalize. Normalization is a fancy word for a simple idea. Don't value a business based on its best year or its worst year. Value it based on what it can earn through a cycle. In other words, what does this company earn in a typical world? Not a stimulus-fueled boom, not a panic collapse, a normal world. This is how you avoid the classic trap of paying peak prices for peak earnings. Because during euphoric markets, especially in sectors tied to excitement like the next platform, the next AI winner, the next revolution, people anchor to a single recent year and extrapolate it forever. Graham would call that speculation wearing an investment costume. So do this mental exercise. If the stock market closed tomorrow and stayed closed for 5 years, would you still want to own this business? Not the ticker, the business. Would the business produce cash? Would it stay profitable? Would it grow in a sensible way? Would it still make sense with a constantly rising quote on a screen? That's value investing. Now, you don't need a spreadsheet to get a rough sense of worth. You can use a conservative earnings power approach. Look at the company's earnings over several years. Ask whether those earnings are stable, cyclical, or inflated. Then make a conservative assumption about what those earnings could be in a normal environment. Then ask the most under-asked question in the stock market. What return am I buying at this price? Because every stock price implies a return, just like every bond yield implies a return. If you pay a high price for a stream of earnings, you're accepting a lower return unless growth bails you out. And growth will bail me out is one of the most expensive sentences in investing history. This matters even more when interest rates move. When safe yields rise, the market often becomes less forgiving of high valuation. When safe yields fall, investors often reach for risk and pay up. But Graham's investor doesn't build a retirement plan around the mood of rates. He builds around value, quality, and margin of safety. So a simple, honest way to frame question 2 is, if this business keeps earning what it typically earns, am I paying a price that makes sense? Or am I paying a price that only makes sense if everything goes perfectly? Because the moment your valuation requires perfection, you're not valuing, you're hoping. And hope is not a strategy, not for a 401k, not for an IRA, not for real-life middle-class wealth. Now here's the part most people don't expect. Even if you estimate intrinsic value well, even if you're conservative, even if you understand the business, you can still destroy your returns if you ignore question 3. And question 3 is the one that can save you in a market crash. Question 3, am I getting paid to be wrong at this price? That is Graham's margin of safety, translated into plain English. Margin of safety is not about being pessimistic. It's about respecting how often humans are wrong. It's the idea that you build your investing process around the assumption that your analysis has flaws, that your numbers will be off, that the future will surprise you, that the economy will change, that competition will show up, that management will disappoint, that something will go wrong. So you don't demand a fair price. You demand a bargain relative to conservative value. You demand a cushion, a parachute, a bridge built thicker than necessary, not because you want drama, but because you want to survive it. This is where the market's biggest traps reveal themselves, because a lot of stocks don't look risky. They look high quality. They look best in class. They look blue chip. They look like they belong in every portfolio, and sometimes they are high-quality businesses. But buying a high-quality business at a ridiculous price is not defensive investing. It's renting safety at an inflated rate. You're paying up for comfort, and the market has a way of charging you twice. Once when you overpay, and again when you realize you overpay. So how do you tell if you're getting paid to be wrong? You think in ranges, and you think downside first. Imagine 2 versions of the future, a calm, reasonable outcome, and a disappointing outcome, not a doomsday, just disappointing. Lower growth, higher costs, a recession, a few bad years, a competitive hit, a regulatory headache, a product cycle that's less magical than expected. Now ask, if that disappointing outcome happens, does the current price still make sense? Or does the stock need perfection just to justify today? Because when you buy with no margin of safety, disappointment doesn't just hurt your feelings, it hurts your capital. And this is the difference between volatility and risk. Volatility is the stock price moving around. Risk for the long-term investor is the chance of a permanent loss or a decade of dead money when you can least afford it. People say they can handle volatility until they see their account down 40% and their retirement timeline feels suddenly real. That's why this question matters. If you're truly getting paid to be wrong, the price leaves room for the business to stumble and still be a solid long-term outcome. If you're not getting paid to be wrong, then your entire future depends on being right. And being right is not something you control. Now let's bring these 3 questions into a realistic example, because this is where it clicks. Let's say you're looking at a stock everyone is talking about. The story is powerful. The narrative is clean. The CEO is charismatic. The product looks like the future. It's tied to AI or cloud or robotics or some mega trend that makes you feel like you're either early or left behind. The chart looks like a staircase to heaven. Question 1. Could it survive a bad decade? You glance at the financial statements. Debt is significant. Cash is thin relative to obligations. The company has issued shares repeatedly. Earnings are inconsistent, and adjusted numbers look better than the real ones. That doesn't automatically mean it's evil. It means it's fragile. And fragile companies don't just fall in price during a downturn. They get forced into actions that permanently change your ownership. Dilution, emergency financing, asset sales at the wrong time. So the first question alone may tell you, this is not a defensive investment. But suppose it passes. Suppose it has real cash, manageable debt, a history of profits. Then question 2, what is it worth in a calm world? You look at earnings over time. You normalize them. You assume reasonable growth, not magical growth, and you realize something uncomfortable. At today's price, your expected return relies on the market staying excited for a very long time. It's not priced for a calm world. It's priced for a world where everything goes right and stays right. Then question 3, am I getting paid to be wrong? You run the disappointing scenario. If growth slows, if margins compress, if competition rises, the intrinsic value range drops, and suddenly you're not buying with a cushion. You're buying on a cliff's edge. That's when you understand what Graham meant by speculation. Speculation is not buying a risky stock. Speculation is buying without adequate protection against being wrong. Now, flip it. Imagine a boring company, the kind nobody brags about at parties, the kind that doesn't trend, the kind that doesn't have a cult following. It sells something unsexy. It operates quietly. Its management doesn't speak in grand metaphors. But the balance sheet is solid. Earnings are steady. It survived different conditions. And the stock price, because Mr. Market is having one of his dark moods, has been pushed down. Now your questions sound different. Could it survive a bad decade? Probably. What is it worth in a calm world? You can estimate it with conservative numbers. Am I getting paid to be wrong? If the price is meaningfully below conservative value, yes, that's the boring edge. That's where defensive investing lives. And notice what you just did. You didn't predict the next headline. You didn't guess the next rate move. You didn't chase the next catalyst. You made a business-like decision using intrinsic value and margin of safety. That's why this works for real life. Because real life doesn't give you perfect timing. Real life gives you kids, medical bills, layoffs, inflation, surprise expenses, aging parents, and a calendar that won't pause while you wait for the market to cooperate. Graham's approach respects that. He built a philosophy for the investor who wants to sleep at night, the investor who wants a retirement blueprint that doesn't depend on genius. Now, I want to talk directly to the most common objection. Okay, but what if I miss the next big winner? Here's what Graham would quietly ask you back. What if you don't? What if you chase winners and end up buying at prices that bake in a perfect future? What if your big winner becomes a big lesson? What if the market gives you 10 years of excitement and then takes it back in 10 weeks? The tragedy of speculation isn't just losing money, it's losing time. A big loss in your 20s is painful. A big loss in your 40s can change your entire retirement outcome. A big loss in your 50s can force a lifestyle you never planned for. This is why the defensive investor cares more about avoiding fatal mistakes than chasing miracles, because wealth compounds best when it's not interrupted, and fatal mistakes interrupt compounding. Now, let's make the 3 questions even more practical so you can actually use them the next time you're about to buy, when you're scanning a stock quickly. For question 1, glance at 3 trends: debt trend, cash trend, share count trend. If debt is climbing, cash is shrinking, and shares are multiplying, that's a fragile setup. For question 2, ask, what is the earnings power in a normal environment? Not what the company says in a glossy presentation, not what analysts model in a perfect world. What has it actually earned through a cycle? For question 3, force yourself to say 1 sentence out loud. My margin of safety is, and then fill in the blank. If you can't fill that blank without rambling, you probably don't have one. And if you don't have one, you are relying on mood. And mood is Mr. Market's game, not yours. Now let's zoom out for a moment, because Graham was never just about stock picking. A lot of people use value investing as an excuse to concentrate risk. I found undervalued stocks, so I'll go all in. That's not Graham. Graham talked constantly about the defensive investor, diversification, allocation, and protecting against your own emotion. So if your goal is real-world security, retirement, stability, peace, these 3 questions should live inside a bigger system, a portfolio with a thoughtful mix of stocks and bonds, a cash reserve so you're not forced to sell at the worst time, rebalancing so you trim what's become expensive and add to what's become cheap, and an obsession with costs and fees, because fees compound in the wrong direction. Even a small fee difference can quietly erase years of progress. That's why get rich slowly isn't a slogan, it's a survival strategy. Now, let's return to where we started. You're back at the kitchen table. Same phone, same bills, same life. But now, the noise feels different. You see the headline, you see the hype, you see the chart, and you don't feel that old pressure. If I don't buy now, I'll miss it. Instead, you feel something rarer in investing: control. You look at the stock and you ask calmly, could this company survive a bad decade? If the answer is unclear, you don't argue with yourself. You move on. What is it worth in a calm world? Not today's market mood. If you can't estimate a conservative range, you don't pretend you can. You move on. Am I getting paid to be wrong at this price? If there's no margin of safety, You don't negotiate with the chart. You move on. And here's the surprising part. Moving on is not missing out. Moving on is investing, because the market will always offer you something. Mr. Market will be back tomorrow with a new price, a new mood, a new story. Your edge isn't speed. Your edge is discipline. Your edge is the willingness to say, not at this price. Your edge is the willingness to wait for value, to demand a margin of safety, and to treat investing like the serious business-like act that Graham insisted it is. So the next time you're about to buy a stock, especially one with a story that feels inevitable, pause. Ask the 3 questions. Let them do their job. And if you want a simple rule to carry with you, make it this. A stock is not an investment because it's popular. A stock is not an investment because it's innovative. A stock is not an investment because it went up. A stock becomes an investment when the business is strong, the value is real, and the price gives you protection. That's how you crash-proof your decisions in a noisy market. That's how you build wealth like a defensive investor. That's how you turn Mr. Market from a master into a servant. And that's how you stop gambling with the one thing you can't replace: time. If you've ever bought a stock because the story was too good and later realized the price was the real risk, drop a comment with which of the 3 questions would have saved you. And if you want, in the next video, we'll go deeper into the Graham checklist, how to screen for financial strength and quality in a way that fits real life, not fantasy.